Welcome back to the Market Insights webinar. This is Kevin Prince from BMO Exchange Traded Funds. We are so pleased you join us one more time and get some insights to the overall marketplace. In fact, we also appreciate those people who have taken the time and effort to send us questions. In fact, we just got some new questions in today. So we appreciate that because that really helps drive our content on a regular basis. So thank you for that. And if you really appreciate this webinar, do me a favor, just tell a friend about it and maybe have them register too. We really appreciate the opportunity to build the quality content for you and help give you the insights to the overall market. Now, when we talk about market insights, what are we talking about? We're not talking about recommendations. We're not talking about specific advice. What we are trying to do is give you some insights around exchange traded funds and the other aspects of the market around it. So with that, what is our key topic today? We're going to spend time and talk about asset allocation and asset allocation ETFs. I have some guests with me today, and joining me for the first time, Steve Shepard. We're so happy to have you on. Thanks for that, Steve. And Mackenzie Box is rejoining us to talk to us about the market itself and the ETF industry. With that, let's get into it. You know, we always like to start off with a tool and some interesting insights around tools. Well, I found one that I really want to highlight here. Maybe take a note of this. It's the portfoliovisualizer.com. There's a lot of tools inside here. I'm going to highlight and focus specifically on one. It's the back-tested portfolio. And if you're following along here, it's the second link saying back-tested portfolio. Click on that. Why do I say that? Because inside that tool, you can type in any Canadian ETF ticker you want, and it'll start to build a portfolio for you and start showing you the asset allocation of that portfolio, and then give you performance carrying back in time from the time it is available, as in the history is available, as well as give you key metrics for your drawdown analysis too. I'll just show you a quick little sample of one of the portfolios we'll talk about later on today, one of our asset allocation ETFs. So take a look at Portfolio Visualizer, very interesting tool, especially around asset allocation in our topic today. So with that, let's get into this, because what we're really seeing more nowadays is we're seeing asset allocation, specifically the asset allocation ETFs, really come into the news nowadays. So we're going to spend some time talking, what are asset allocation ETFs and why are they important? And we'll start that off, of course, with Mackenzie. Can you give us some insight? What are asset allocation ETFs? And we'll talk about why they're important too.
Sure. Thanks, Kevin, and thanks everyone for joining today. I think, you know, just taking a step back and really understanding what our asset allocation ETFs is, they're simply all-in-one, one-ticket solution that generally holds underlying ETFs to give you your exposure based on your risk. So generally we see there's conservative ETFs, there's balanced and growth. So depending where you are on the spectrum, we're seeing more of these products come to market that allow you to target, you know, where you want to be in terms of your risk, and in terms of which ETFs you're looking for. And, you know, in the last couple of years, we've really seen these come to market. You know, people are interested in the, you know, one all-ticket solution, low cost. And it's really been the only area in the last little bit where we've seen a lot of growth in the ETF industry and innovation in that regard. You know, Kevin shared a few interesting stats with me this morning that in 2009, the ratio of US mutual funds to Canadian ETFs covering the US market was 22-1, and currently it's 4-1. And even more interesting is that if you look at the balance category, those numbers in 2009 were 500-1, and now they're 200-1. So there's still lots of room for growth. You know, traditionally investors have been using ETFs for certain exposures, you know, recognizing the benefits of them, the low cost, transparency, liquidity. But now with, you know, the growth of asset allocation ETFs, investors can easily access these one-ticket solutions that, you know, give them exposure to a balanced, conservative or growth portfolio.
Thanks for that, Mackenzie. And, you know, there's been a lot of innovation in the marketplace. I mean, certainly saw that Vanguard popularized this solution set, and then both iShares and us joined the market there too. And, you know, we're happy to also bring some innovation to the marketplace. Maybe we can talk to this about this briefly too. The first ESG-focused asset allocation solution.
Yeah, so I mean, generally we've seen a lot of the asset allocations come to market across the risk spectrum, but more recently we actually launched a ESG balanced asset allocation ETF, and you know, I think that just furthers to the innovation in the industry. You know, now investors can, you know, pick where they want to be on a risk spectrum, but also align their investments with their social values, and you know, the appeal of it is gaining traction, and now you can kind of tilt your portfolio. So, you know, if you want that core solution, or if you want, you know, a certain exposure to ESG, you can leverage these ETFs to add to your portfolio. So, you know, we came out with this one early this year, but we've seen more come to market. I know iShares have launched an ESG asset allocation ETF, so we expect to see more innovation within this in the coming years as well.
Oh yeah, we've certainly seen the popularity of social responsible investing coming to the forefront, especially in the last year, and I think it's going to be a key thing going forward, that social responsible investing. So with that, let's keep going here. Mackenzie, tell me why these have become popular tools for investors in the marketplace.
Yeah, and I think the appeal of being, you know, the low cost, one ticket solution, easy to access portfolio construction tool is really appealing. You know, I think investors are continuing to gain traction to ETFs as they recognize the benefits of them. But now with asset allocation ETFs, it's almost a little bit easier for them as well if they're looking for, you know, certain broad core exposures. And, you know, like I mentioned before, why an asset allocation ETF, you know, they're leveraging all the same benefits as ETFs with the liquidity, the transparency, the diversification, giving you access to a basket of several ETFs that hold underlying securities. You know, simplified investing, an all-in-one solution that provides instant diversification, professionally constructed. Everything is done for you. You know, you get the benefit of portfolio managers making those asset allocation calls for you, you know, with years of experience, automatic rebalancing. Steve will touch on that later. And then of course, low cost. You know, everyone's looking to benefit from lower fees. So I think, you know, the benefits of ETFs overlaid with the asset allocation, you know, getting your professional management from your PMs, I think these are a great appeal. And of course, cost. You know, everyone's looking to benefit from a lower fee.
Thanks, Mackenzie, too. And I'd like to stay transparency on that list too, because when you talk about portfolio construction, knowing what you hold inside a portfolio, you can better build a portfolio to understand when you're complementing it with something else or duplicating it, of course, across the board. So, but you know, one thing you highlighted, two things you highlighted. First and foremost, you highlighted asset allocation. So Steve, let's bring you into the picture here. You're a portfolio manager. You're familiar with all asset allocation, of course. Talk to us why asset allocation is an important consideration.
Absolutely, Kevin. I'm happy to. This chart really says it all. I started in the industry in 1994, and there was a major breakthrough in the idea of portfolio theory in the early 90s. And it was summarized by coming out of a study done by Brinson and Biebauer. And what they found when doing a back test of returns of various markets is what's stated here on the slide. And it went something like this. Up to 92% of the volatility of your portfolio return can be accounted for by asset allocation. Now, to unbundle that a little bit, what were they saying? They were talking about how bumpy the ride was a decision of your portfolio mix. They weren't talking about how much money you made. It was just how bumpy or how variable your rate of return from year to year might be by following a diversified asset allocation plan. And if you look at the pie chart on the left, you can see the things that add up to less than 10% of the final result: security selection, market timing, other. That would be a bucket in which I would put things like global pandemics and US elections. All of these things added up to less than 10% of the result. And yet time and time again, no matter what the event is, we find that these are the things that dominate up to 80 or 90% of a person's mental shelf space. Well, they updated that study at Ibbotson in about 2000, And what they did was they expanded the universe. The original breakthrough study was done with all of 3 asset classes: US cash, US 10-year bonds, and the S&P 500. Well, for the new study, they actually expanded the universe to properly represent global capital markets. They included things like international stocks, small cap stocks, investment grade bonds, high yield bonds. And what they found was actually close to 100% of the absolute return. So the actual money you put in your pocket could be accounted for by your asset allocation decision or your model portfolio choice. So this is basically your long-term strategic mix for the portfolio. And as Mackenzie said, you might be a conservative investor, a balanced, or a growth. That's really a function of your long-term return requirement. But asset allocation really is what drives the long-term risk-adjusted performance of any given investment portfolio, Kevin.
Oh, thanks for that, Steve. Well said. Now, the other thing that Mackenzie talked about too, and you know is quite familiar, you're quite familiar with this, is rebalancing. Talk to us a bit about rebalancing, the importance of that, and what that means with Inside Solutions.
Absolutely. One of my favorite quotes is, I believe it comes from Warren Buffett, or maybe Charlie Munger, his colleague. What we do is simple, but not easy. And that is the best description I can come up with when it comes to rebalancing. The fact is, everybody knows the basic of investing: buy low, sell high. Easy to say, but very difficult to do, particularly when you're being impacted by media, news, all the things that we worry about in a given day. But on the upside, it's also very difficult to let go of a winning stock or a winning position in an ETF. What rebalancing does is it takes the emotion out of the discipline of taking profits on your winners and adding to things that have lagged behind your overall portfolio or the broader market. This is the only way that you're going to reliably capture the idea of buying low and selling high. On this chart, as you can see, depending upon the different risk profile, whether it's an aggressive portfolio or a conservative portfolio, even by setting the clock to automatically rebalance back to your target allocation on a quarterly basis, so just 4 times a year, you can actually add significant value over the long term. Because if you're not taking profits at those when something is outperforming the broader market, you're not going to capture as much upside return relative to the market. And that's really the only way to outperform, is if you are selling things before they stop going up, or more importantly, before they start going down. And that's what a disciplined rebalancing strategy brings to the table.
Steve, thanks for that. I mean, that's very insightful and just shows one of the key value adds of any of these asset allocation solution sets, or effectively just the core idea of an asset allocation is rebalancing. Mackenzie, let's take this and put this to work, because Steve talked about the 92% volatility, as well as he talked about the performance aspect. I know you put together some examples of how an asset allocation could be brought into a portfolio and what the diversification brings. Walk us through your example, please.
Sure. And I think Steve said it very well. Looking here, we included 3 different portfolios. So one is a few different stocks. So these are just examples. We just pulled in some names, popular stocks that you'll see on BNN and whatnot. So the first portfolio being cash and different stocks. Second portfolio being all stocks. And the third portfolio being a asset allocation ETF, more of a growth focus with the stocks as well. So if you advance to the next slide, we actually charted this over time, and it's quite interesting because you see, the blue line, which is represented by all stocks, you see the highs and lows of the market, and then comparing that to the red line, which is your stocks and 50% cash. You're not riding the highs and lows as much, but you're also not benefiting from the return. Whereas the green line, which is the combination, actually shows you that you're smoothing out your returns, but you're also participating in that performance as well.
Good example. And of course, I also like the fact you used like Z Grow, for example, which is one of the more growth-oriented portfolios. So it's interesting to see how that diversification starts to give you more of an exposure that protecting those downsides because it's diversified, but still participates in the up. Certainly not as much as a concentrated security portfolio, absolutely, but very interesting how you can use these in combination and diversify the portfolio. And going back to Steve's initial point there, asset allocation, key determinant of your volatility or portfolio performance. This chart sure shows you that too. Let's dive into a little bit too. We've been talking about asset allocation ETFs. We showed some neat little pie charts up there. Let's do one more thing. Let's dive into what we mean by asset allocation ETFs and what you tend to see within inside these asset allocation ETFs. Because you said they were one ticket holdings. What's a one ticket holding really mean? Do I really just get one?
Yeah, so thanks, Kevin. I think one of the things we've been saying throughout this is diversification, diversification, diversification. And if you look at this, what you'll actually see is, yes, what you're buying is a single ticker, but if you look under the hood, you'll see that, you know, the ETF is holding around, you know, generally they hold around 7 to 8 ETFs, but then each of those ETFs hold the individual securities. So I just did a quick snapshot of the holdings here and just highlighted the underlying holdings. So, you know, tallying those all up, you're at 4,000 individual securities that you're getting exposure to. So, you know, you really do want to look under the hood and see what each of those underlying securities is holding. And you kind of see this across the board. Like I mentioned earlier, you know, we've seen other players come to market. Other providers have different asset allocation ETFs across their offering, and you know, generally they're going to kind of trend similar, but there are slight differences, and you want to make sure that you are looking under the hood and really understanding those. You know, cost is always something you want to be mindful of. You know, fee differentials, but then as well with the holdings, you are going to see differences. You know, some might tilt more towards global exposures, or some might be more North American focused. So, you know, when you're looking at these, yes, they're providing that diversification, but you always want to make sure you know what the holdings are and where they're coming from.
Thanks for that, Mackenzie. And then Steve, you know, again, you kind of highlight off the bat, you've been in the industry since 94. So using your experience, how has portfolio construction changed over the last 20 years?
Sure. It's said that the most dangerous words of it in investing are, it's different this time, or it's not the same as it was back then. And sometimes that's true, but in this case, it is absolutely true. It used to be that bonds were considered the safe asset class. You didn't have to worry about governments going out of business. You didn't have to worry about things happening in the world that might impact the rate of return that you're getting. And it was a generally accepted rule of thumb that the more conservative you are, the more bonds you should have in your portfolio. And looking at this chart, it's easy to see why. Back in 1999, at the end of the year, if you had looked back 5 years, your annualized rate of return on that bond, which is represented by the Canadian Bond Universe Index, it would have generated a 9.9% rate of return with only a standard deviation, which is a measure of risk. Think of a pendulum swinging back and forth. That standard deviation associated with the return was only 5. So that's almost a 2-to-1 ratio. So in terms of risk-adjusted returns, that's exceptional. But let's take a look back at what was happening back then. If you take that same time period, you began that time period with an interest rate that was running at 8.25% on a Government of Canada 5-year bond, and fell to a low of 4.75%. Now, over the entire 5 years, you actually saw interest rates drop a little bit more than 2%. It was about 212 basis points. But the point here is that we enjoyed a bull market in bonds for over 30, 40 years that not only provided much higher yields in higher interest rate environments, but also added on to that potential return with capital gains associated with falling interest rates. Fast forward to today and the end of last year, before we had to worry about COVID and even elections so much different year, much different environment. we're still we can still see in the rearview mirror the impact of the global financial crisis that hit the world in 2009, 2010. Obviously, the stock market has had a phenomenal decade in terms of generating returns. But the key point here is that in a low interest rate world, a slower growth world, it is impossible to generate that same level of return that you could back in 1999 by owning 100% fixed income. So when you look at the portfolio on 2019, you can see that Canadian bonds actually represents, I believe, less than 10% of the total portfolio to generate a return roughly approximating the 1999 return. It's a few basis points higher. But the key point here is that you've had to take on the integration of some quote unquote riskier asset classes, and your perception of risk might vary, but it used to be emerging market equities was an asset class reserved only for young, independently wealthy people that liked motorcycles and skydiving. Well, in fact, it represents 20% of the global economy. It's a core asset class. But what you're seeing is that you're seeing a shift in the global market and what you need to integrate into your portfolio to realize the same long-term return. Now, the volatility measure is a little bit higher, but only modestly so. When you consider the individual risk levels of all these asset classes like emerging markets are much higher, into the double digits, with volatilities approaching anywhere between 15 to 20% on an annualized basis. So why is this portfolio risk level so low at 8.25? It's because of what's said to be the only free lunch in investing, and that's diversification. The fact that these asset classes in the portfolios have correlations lower than one, meaning that one zigs, the other one zags, that's how you get the benefit of diversification, which actually improves your risk-adjusted rate of return. This is like saying pound for pound, your portfolio is stronger than if you had a less diversified portfolio. So what that means to the investor is that if they're trying to target a certain rate of return, they can do it with lower risk, or for the same level of risk, they can actually realize a higher rate of return than by simply buying one asset with the same level of risk. All of these things are what help keep the portfolio on track for the long term, lower your volatility, help you sleep at night, and most importantly, stay invested for the long run.
Well said, Steve. Hey, Steve, let's stay with you for a bit, because as a portfolio manager, you have some key considerations when you look at the marketplace. So let's say you had one of these asset allocation ETFs and you want to start to tilt it or add towards it. What are some of the things that you look at when you're building a portfolio and managing it?
Sure. Now I'm a member of a 30-person team that focuses on global markets on a daily basis, and we talk to each other on a constant basis. So there's no end to information that you need to absorb in terms to keep track of your portfolio. So what helps keep it simple is to have a framework. And this is a framework that I think about whenever I see any piece of news coming in. I ask, is it impacting the economy, the policy, whether it's the central bank or the government? Is it something new in terms of the market, whether it's valuation multiples or an earnings announcement or free cash flow multiples? But what's really been driving the market lately, of course, would be behavioral factors, mostly sentiment and volatility. We've seen volatility spike up massively during the COVID pandemic, only to come back down. We're still tracking a little bit higher than usual. But by basically trying to categorize or evaluate asset classes by these four buckets, if you will, it really gives me kind of a pre-flight checklist when I say, is this a market that has an opportunity to outperform or underperform, or should I just stay benchmark neutral? It's okay to be benchmark neutral in an asset class if you don't have a compelling thesis as to whether it's going to go up or go down. One thing I like to say when it comes to asset allocation is never confuse activity with productivity. Just making an overweight or an underweight trade in your portfolio just for the sake of doing something, sometimes it's better served just waiting and being patient and staying in that core positioning that an asset allocation ETF offers.
Thanks for that, Steve. And I like the framework thought process, because that kind of helps people, because we all, you're right, get a lot of news given us on a daily basis. And having a framework for taking that news in only helps people manage and run their portfolios. Now, Steve, as a portfolio manager with your team that you work with, give us some insights, what your current thoughts and around the marketplace and positioning across the board there, if you can.
Sure, and this chart is a little bit out of date, but I think it's a great example of just to tell you how we categorize things. This is basically a graphic representation of what every chart and graph we look at among us adds up to in the span of a quarter. But really, the way I like to characterize this is if you've ever seen the cockpit of a airliner or a 747, there are all these buttons and switches in front of the pilot. These are my buttons and switches, the major levers that I can push and pull on to try to add value beyond a buy and hold position. So if I were looking to complement something like a core strategy, my first decision is asset class. Where do I want to be in terms of equities? Do I want more equities or less equities than usual? And right now, we are firmly biased towards equities offering substantial value as compared to fixed income. We're actually looking at this chart, it's only at a 1 out of 5, that's a subjective scale. We're actually more optimistic on equities than we were prior to the election. And obviously the COVID vaccine news this week is encouraging, but that's not the only reason we are. On a relative basis, we like equities. On a global basis, we're currently overweight the US and emerging markets, and we were positioned that way last quarter. A lot of the reason for that is the dominance of the tech sector in the US that had really been driving markets on a year-to-date basis. Certainly since the market lows of March 23rd, we saw how tech really benefited from that stay-at-home trade. And we've also been overweight emerging markets. China was the one economy in the world that probably fought the pandemic faster than any other economy. And it's still on track to deliver a 1.9% positive GDP growth for this year. Lens 3 is a little bit more difficult. It's our fixed income view. Very quickly, we are modestly bullish on investment grade credit because of the US Federal Reserve's buying program. They have firmly put a floor under the market, acting as the buyer of last resort. And that really helped the operation of the fixed income markets during the market sell down in March. We are less optimistic on duration. We are actually pulling that back to neutral. We had a slightly long position in duration or interest rate risk as a counterbalance to some of the volatility that we expected in markets because of COVID. A couple of months ago, we didn't have the clarity on the vaccine trajectory or the second wave, but mostly around the election. We weren't really sure what was happening. Now we feel that we don't really need that long duration to counterbalance the same amount of equity risk, so we're actually pulling that back to neutral. Lens 4 is currency, and it really gets towards currency hedging, whether you want to be hedged back to the Canadian dollar or not. We are not, over the medium term, terribly optimistic on the value of the Canadian dollar relative to global currencies. All of our portfolios are currently unhedged. The US dollar relative to the Canadian dollar is actually an important diversifying defensive factor because when markets get volatile, the US dollar being the biggest reserve currency in the world tends to be a very defensive asset to have. So we don't want to hedge that away quite yet. Lens 5 is factors, and I think this is a very important area of the market that maybe people aren't as familiar with. This is the genetic DNA of the markets. And one of the factors that we like particularly is low volatility equities. We've found in our studies that if you mix a little bit of low volatility equity in with its underlying home market, so for example, the TSX and the Canadian Low Volatility ETF that BMO offers, when you mix those together and hold it for the long run, you actually get a more risk efficient exposure to the Canadian market over time. So it's just about making small adjustments at the margin. All of these factors is what we focus on every day, trying to come up with the satellite overweights or underweights to a portfolio. And it's not like we're moving 30 to 40% of the portfolio at any given time. Asset allocation is about making small, disciplined rebalancing changes. But these are all the things that you really need to consider when you're managing your overall portfolio, where you're exposed, but more importantly, where you might have too much risk already allocated to.
Thanks for this, Steve. And that's a very, first of all, very compelling framework, first of all, and then I appreciate you sharing your current thoughts on the overall marketplace itself. You know, you mentioned that you can maybe tilt some time, thoughts around low volatility, the addition of low volatility in that. For those listeners out there, you know what? You can actually build a simple portfolio. Let me quickly show you that using the asset allocations. And what Steve mentioned right off the bat there was a core and satellite approach. The key thing for you as investors, decide what your actual objective is, right? And that being your asset allocation, your risk tolerance around it, and then your objective, your needs and income across the board, because you can use those needs to determine whether you want to have a little more income in your portfolio, a little more growth, a little or more some volatility mitigation across the board. And you can still do this with a very simple portfolio construction out there. And give you one example, and you can do lots of this, but with one example, here's one where we simply took one of the ETF portfolios. We actually used a balanced portfolio here. Now, I know we talked about growth before. This is actually really still giving you a growth asset allocation. We're taking a balanced portfolio and we're adding to it to build up the equity mix to deliver that more of that growth-like portfolio. But in this case, it's bringing in low volatility ETFs because still to manage the risk. So it's growth, but with some low volatility in it to manage that risk going forward. And what we're quickly showing you here is you can still leverage those asset allocation ETFs that are out there, right? But you can bring in this case, 3 low volatility ETFs to have a 4 ETF portfolio. And again, a very diversified asset mix across the board. We're just trying to show you here, of course, how you can use these tools out there. You can, of course, use the asset allocation tool ETFs as an all-in-one solution for a portfolio. Absolutely. You can also use them like this as a tailored approach to have a simplified way to building your portfolio. I think they're really great additions to the ETF marketplace, and I'm looking forward to see them continue to expand as we go forward. We're going to shift gears here. We're going to take it into questions. Before we go to questions, I just want to make a quick shout out for next week. Next week on the 20th, our focus will be in regards towards tax loss harvesting. Nice new show. What I'll highlight for that, it's going to be a special show. We got a lot of guests for this one. We're going to bring in John Waters, the head of tax, to walk through that tax loss harvesting strategy. In addition, we have Alfred Lee join us to talk about some examples with ETFs, you implementing that strategy across the board. And last but not least, we're going to use the backdrop of Advice Direct to really show you all the key considerations in making that decision. So hopefully you can join us next week on the 20th. So with this, let's get into some of the key questions. I'm going to start off on volatility. Now, Steve, we've certainly seen the volatility bounce around a bit here. And really what they're looking at here is, you know, where are you positioning right now on volatility, and what's your thoughts in regards towards volatility in the marketplace?
Sure. I mean, volatility is natural in any marketplace. If there wasn't any, you would have no chance to outperform. This is what makes markets work. But the level of volatility as measured by that VIX, which for people that aren't familiar with it, it's a measure of volatility indicated by options traded on the Chicago Board of Exchange. But just to put some numbers to it, back down to 23, it peaked over 50 during the height of the global pandemic and the market sell-off. We're back down to 23, but you have to take into account that the long-term average for that VIX index is actually somewhere around 15 or 16. So to say that things are back to normal, not quite yet, but certainly getting there. I see the question talks about gold price. A lot of people were buying gold as a hedge against volatility as well. But, you know, is the crisis over? I would say firmly, yes. We are well past the crisis and we are recovering. Now, people are saying we're not recovering as fast as we did in the early days, but that's just natural. When you go down 40%, the first 20 to 30% back is easy. It's the last 10 that's somewhat difficult, and we're seeing that in any number of measures. But the idea of making all-time highs, that's not something I think about on any given day. I think more about what is the relative direction of the market and how have those 4 pillars changed. and everything we see is to the positive. Well, not everything, but the majority. The economy is still growing positively. We've got tons of monetary and fiscal support. We've got some clarity around the US election. And hopefully we won't be talking about COVID vaccines next summer, and ideally getting life back to a little bit more normal. So I think the idea of seeing 40 to 60 on the VIX again anytime soon, while not impossible, is certainly improbable.
Thanks, Steve. Mackenzie, I've got one for you to answer. This is coming in regards towards ZUT, our utilities-based ETF. And, you know, inherently with inside the ETFs, a little more focus on renewables. Also taking a look at our cover call version of utilities, WU, and maybe why there's some differences between the two. And then, of course, what's this? We're certainly hearing about the differences in the media too. So maybe talk us about each part of those, please.
Yeah, sure. And first off, good for you for the question, and good for checking the holdings, because you know, it's something we always say is you always want to look under the hood and compare the holdings and actually see what you're holding in the respective strategy. So when you look at ZUT, that's actually 100% Canada exposure, whereas ZWU is about 30% US holdings. So a little bit more North American utilities, obviously with a Canadian tilt. And I think really when you bring in the derivative strategy to this, you know, we need liquid options, and hence why the strategy is more North American focused. We bring in a little bit of the US for some diversification on that. And, you know, we are seeing a lot of this in the media, and, you know, where the media is comparing one versus the other. But I think, you know, when they are comparing it, it's more from a performance standpoint. And, you know, I think this is where it's important to really look under the hood and understand the portfolio is, one is more of an income strategy, right? So, you know, with ZWU being cover call strategy, that's definitely more income focused. So you just want to be mindful that when you are looking at these ETFs, understanding what the key differences are. You know, and if your objective is to go more green going forward, we do have a global ESG covered call solution, ZWG. So you're getting that exposure, but you're also getting that higher yield kick as well.
Thanks for that, Mackenzie. And I think, unfortunately, we'll have time for one more question. And I'm going to pick the question because I think this is the one that's in a lot of people's minds. I'm going to go to Mackenzie. Maybe you can give us some insights. What ETF holds the largest amount of Pfizer? Give that to us if you can.
Yeah, sure. You know, intuitively, when you think about this, we have a healthcare ETF. You know, your mind might go there, but actually our covered call US ETF, ZWH, actually has the largest amount of Pfizer in there because it's a more, I would say, concise basket. There's more exposure to Pfizer in it. If you are still looking for that, you know, our healthcare ETF does still have around 2% versus ZWH is around 3.8% currently.
Thanks for that, Mackenzie. And for those people that sent questions in, I'm going to commit to making sure you get a response to all those questions. So thank you for doing that. And for those of you out there, please send in your questions for next week. Because next week, we're going to focus in on tax loss harvesting strategy. Hopefully you can join us for our special edition. We're going to have John Waters one more time from our tax group, as well as we'll have Alfred Lee, our ETF strategist, join with us at Vice Direct to give you some good examples of tools itself. Look forward to you on the November 20th, one more time at 1 o'clock. Thank you. Have a good week ahead.